Mark, I know you would agree with that kind of sentiment that the bigger risk here is a more significant drawdown. Do you, like Sarah, see some sort of significant downturn or recession on the horizon in the near term?
No, I don't think the recession is likely, but I do think there's enough evidence at this point for the Fed to start cutting interest rates. The economy is slowing. I mean, we tracked GDP growth for this first half of the year at 1.5% annualized. It's down from 2.5% last year. And that's below the economy's potential. Unemployment starting to notch higher. Initial claims from unemployment insurance are starting to push up. Other labor market indicators are showing some softness. So, and given that inflation is coming in within spitting distance of the Fed's target already, particularly if you exclude the very problematic OER, owner's equivalent rent, the implicit cost of owning a home, which is very difficult to measure. So I think everything suggests very strongly that the Fed should be lowering interest rates. And now, if they wait another month, two or three, maybe even after the election, I think we'll still avoid an economic downturn. But why take the chance? Why take the risk? And besides, in this kind of environment, the economy is very vulnerable to anything else that can go wrong. And goodness knows there's a lot out there that could go wrong, including the upcoming elections.
Well, Mark, you couldn't sound more different from Michelle Bowman, who today said that there is an upside risk to inflation still, and it is not time to cut. As Neil Dutta says from Run Macro, is the Fed looking at yesterday's data? Are they behind and in potential danger of making a policy error?
Yeah, there's a real chance that they're going to make an error here. In my humble opinion, I do think that the economy is softening very quickly. I mean, and so far so good. That's kind of to script. That's what the Fed wanted, and important to getting inflation back in the bottle. But I do think the economy is fragile. The other thing I'd point out is the financial system is under a lot of pressure. The yield curve is still inverted. That's just not a very good place for a lot of banks and other financial institutions. Loan growth is slowing because of the tightening and underwriting after last year's banking crisis. Credit quality is moving in the wrong direction. Still good, but moving in the wrong direction. Regulatory costs are up. So, the system is under a lot of pressure, and when it's under a lot of pressure for long periods of time, as it has been and will continue to be with this too high for this higher for longer strategy, something else could break, and the next thing that could break might not be conducive to being fixed like last year's banking crisis was. So, yeah, I think the risks are at this point asymmetric, and the Fed should start cutting interest rates.